it's unusual to hear those words, right? Very welcome. Come on in. Is it recording? Okay. All right. Good afternoon. Welcome. I'm very happy to see you here. Welcome to the Levy Institute Speaker Series, and I'm very, very pleased to welcome, I will say, one of our own. Joerg Bibow is a research scholar at the Levy Economics Institute and has been working at the intersection of Keynes, Minsky, Schumpeter, liquidity preference, but he is a professor of economics at Skidmore College, and his main research areas are international finance and European integration, as well as international trade and development and the history of economic thought. As I said, a particular research focus is central banking and financial systems and the effect of monetary policy on economic performance, especially the monetary policy of the Bundesbank and the European Central Bank. This work builds on his earlier research on monetary thought of John Maynard Keynes. Bibow has lectured at the University of Cambridge, University of Hamburg, Franklin University, Switzerland, on central banking and European integration, and has been a research scholar at the Levy Economics Institute for a few years now. I actually don't know how long you've been affiliated with us, but it's been a while. Received a bachelor's degree with honors in economics from the University of Wits, a diploma from the University of Hamburg, MA and PhD in economics from Cambridge University. It is my pleasure to welcome you back to the Levy Institute after a long sabbatical. All right, take it away.
Thank you, Pavlina, for your kind introduction. It's been a while since I've come to the Levy. It's always a pleasure to come back. And you're right, the first time I came here is 25 years ago, 2001, when Godley was around. Wynne was my teacher at Cambridge, so it was fantastic to reconnect with him and spend a year here at the Levy at the time. That's a long time ago, yes. All right, so working on this project, I'll be talking about money and payments, a field where lots has been happening for the past 10 years. And lots of talk about evolution or revolution in payments. I should acknowledge that much of the work on this project happened when I was in Hamburg at the Hamburg Institute for Advanced Study, so I gratefully acknowledge their support. All right, so question is, do we see an unbundling of banking? Ajit, Michael, good to see you. Do we see an unbundling of the traditional banking functions, lending, deposit taking, payments? Some of the innovations we are seeing might suggest that is what is happening. So then the question would be, what does the future of payments hold for the future of banking? Do we see payments untethered from banking, pun intended? Or will payments still be in the future of banking? Towards the end, I'll also think about what the implications might be for central banking, monetary policy, and monetary theory. I will start with talking about some conspicuous dichotomies in money and banking. Then take a look at Keynes and Schumpeter and Minsky synthesis of their views and theories of money. Then undertake a brief review of some micro-theories of banking. Moving on to talk about regulation, banking regulation, and its challenges. Then focus on some concrete examples of what has been happening, who are the challengers in payments, and what do we see in different countries. There is a lot happening around the world in this field, and it's not quite clear where this is headed, but it's becoming clear that this is a matter of geopolitics today as well. Then, as I said, I'll talk about implications for monetary policy and briefly monetary theory before I conclude. So let me start and point out that there is a series of very conspicuous dichotomies. We have Keynes and Schumpeter as the heretics who challenge the mainstream fundamentally in these issues. So the first one is the money neutrality postulate, which characterizes mainstream thinking about money for many centuries. This idea that money is neutral beyond the short run, it doesn't really do anything that shapes economies. We can think about the economy in real terms, abstracting from money. So all those ideas which are central to mainstream economics, both Schumpeter and Keynes fundamentally challenged those views and argued that money itself was a real factor shaping economic evolution in capitalism. The second dichotomy is, what kind of money are we actually thinking about? So the mainstream is centuries ago coming from this idea that money is gold, is a commodity, is something real itself. And that still seems to be kind of where today's mainstream is coming from. Or it's just the nth good, which avoids us through going barter. And all these related ideas, again, Keynes and Schumpeter, they were thinking in terms of bank money. Bank money. So a claim against the bank, a financial institutions that is lending as well, and it's creating the money by lending, which gets me to the third dichotomy. The mainstream, until today, keeps on imagining that banks are somehow taking deposits in which they then lend out. They are intermediating from savers to investors. They're somehow taking those deposits. They apparently need those deposits in order to do their lending business, right? So all these three dichotomies, they are closely related. They shape the way the mainstream is thinking about these issues and has been thinking about these issues for centuries. And again, Schumpeter and Keynes fundamentally disagree, making it clear that banking consists of lending, and those loans create the deposits that we call money. All right, why does the mainstream ignore all that? Well, there are some interesting examples. There was 10 years ago an interesting paper by Jacob and Kumhoff, who actually use the mainstream core model, DSGE model, and they try to model kind of these differences, and they come up with the results saying, wow, this really matters, this really makes a difference. And they kind of conclude with, well, like everybody should learn from this, and we should, actually nothing happened. Nothing happened. If you look for reactions, there are like 2 or 3 papers that responded to it, otherwise the mainstream just continues doing what they've ever been doing. So banks are still financial intermediaries that wait for depositors to carry their savings to the bank, and then they somehow lend them out. Weird. It has nothing to do with how banking actually works. Okay, so Schumpeter, if you look at Schumpeter's works, he clearly emphasizes very much that those entrepreneurs, which shape capitalism, right? We all know this notion, destructive those creators that also destruct what exists, they need finance in order to do so. So he highlights the bankers as the ones that enable the creative destruction. Without them, it's actually not happening, right? And he has some macro aspects in his thinking, but I would say he mainly highlights the micro part of bankers, namely picking projects. Which project is going to happen and which one is not going to happen. The bankers, as effer, as gatekeeper, as he calls them, have fundamentally a part to play in that, in shaping the evolution of capitalism. So that's kind of the micro part, the allocation of finance. Keynes, and if you look at, like Schumpeter is writing about Keynes's works, and Keynes in the treatise refers to Schumpeter. They are fundamentally agreeing about this point. They are aware of what the other is saying. So Keynes at one point in the treatise says, yeah, we can take this kind of Schumpeter view without any change. We just need to highlight the macro part that is important here, that the banking system is shaping kind of the macro performance of the economy and how this is kind of the lever for the authorities to try to manage macro evolution. Then, of course, we have Minsky, who Schumpeter was not his advisor, but in some sense, he clearly learned a lot from Schumpeter, and he had a number of papers explaining the influence of Schumpeter on his thinking, making it very clear that he sees his own work as a synthesis of Keynes and Schumpeter. And Minsky, of course, takes what he learns from both these heretics and develops his own theories of financial evolution. And there is the kind of the medium-term part of his thinking, which we know as the financial instability hypothesis, but there's also the longer-term analysis in his work where he's talking about the evolution of practices and structures in the financial system, right? So again, this is not kind of something that is neutral in any reasonable way. It is fundamentally shaping capitalism. So how do payments and payments innovations matter? If you look at this question from the mainstream perspective, and the mainstream here is focused on money as a medium of exchange, right, a convenience, it looks like, yeah, it's gonna make payments faster, so that should be useful. It should be kind of a productivity booster in a way, or make money even more convenient, right? But that seems to be it. If you look at this question from a Keynes, Schumpeter, Minsky perspective, it becomes far more complex. So these thinkers would not deny that it could have those efficiency boosting effects that the mainstream is talking about. But the far more important issue is whether these innovations might reshape financial structures, right? And this is where I'm coming from when I ask the question, is this kind of an unbundling of banking that we see, an unbundling of the traditional functions of banking as they have existed for centuries? Is that what is happening, right? And if it is, if it's really reshaping banking, then we should expect this to reshape banks' ability to provide finance to the economy and provide liquidity to the economy, and this could have pretty widespread repercussions. Unless we simply assume that there's nothing to worry about and the invisible hand is just going to take care of things, and if there are some changes, then there will be some automatic adjustments and we can just ignore this point. I'm not so sure. I'm not so sure. So I think from a Schumpeter, Keynes, Minsky perspective, this is an issue we should pay attention to. All right, so far that's the kind of broader macro picture. Let me now take a look at like prominent micro approaches to banking. And I will do so basically ignoring that much of this really is fully in the mainstream frame of thinking, and instead look at, despite those flaws, is there something there that we can still usefully learn from those approaches? So the first one I'm looking at is kind of Gurley Shaw, very important work, and Tobin contributed there. Again, if you look at the post-Keynesian literature, you will find lots of critical work on these economists, and that may be relevant, but despite all that, I think they make a very important point, which is, how do we understand those institutions that go in between? That go in between. When those two parties that go in between might also have the opportunity to deal directly with one another, right? So what is the purpose of the party that goes in between? It must serve both parties, otherwise they wouldn't make use of it, right? And obviously the intermediary, if it's a bank or someone else itself, must also be profitably doing whatever they are doing, otherwise their business could not be sustainable, right? And so they kind of intermediate between these two sides, these two parties. And I think we can see here kind of how regulation is approaching banking by thinking about this as transforming risks or transforming maturities, right? And this is where regulation is focusing. Tobin makes the point that despite the fact that banks create money by making loans, that doesn't imply that they're gonna create infinite amounts of money. Rather, he emphasizes that this is a profit consideration. A bank will only lend or buy an asset, thereby creating liquidity if this seems like a profitable undertaking for them. So balance sheet expansion is limited by prospective profitability. Looking at this branch of literature, I think the question here is whether faster payments could make banks and other financial institutions in some ways more similar, less special. And also what we're seeing is, and this is not new, we're seeing what I call extending chains of intermediation, right? So we have whatever money market funds who provide money-like instruments, who are actually lending to banks, either by wholesale deposits or repo or whatever. And we have those money market funds who are lending to corporations, or there's a lot of talk these days about private credit. They might lend to entities which then lend on to enterprises or whoever they're lending to. So we see those change of financial intermediation, and in each step or in each of these chains, we kind of have to ask, okay, why does it make sense for this party to go in between? It does seem to serve both parties, and it also does seem to work for the party that goes in between, right? So those chains are getting longer, the system is getting more complex. Why is that happening, and how is it working for the parties involved? I think we see kind of thinking along these lines in Keynes' treatise on money when he talks about financial circulation. All right, so that's the first part. Then I look at asymmetric information. Again, as I said, there may be lots of things that post-Keynesians don't like about it, right? But I think there are parts in it that are of some relevance, even if asymmetric information is really just a tiny bit of what Keynes calls uncertainty. So we have more hazard, adverse selection, credit rationing as the equilibrium outcome in these models, and banks emerge as specialists in selecting and monitoring risks. More generally, I think this literature is giving us insights into why banking is relationship banking, right? That banks happen to learn a lot about their borrowers And they learn a lot about them, not least about managing their payments, right? So I think there is an important connection here highlighted in this literature about how information is gathered from payments. And again, my question is, if this becomes untethered, right, what would the implication be for banking going forward? All right, and there's of course the notion open banking, right? So banks should make, or customers should have the option to make their information available to other fintechs, other players, right? So this is part of what we are seeing. Does it have influence on reshaping financial structures? Does it change banking? Possibly. The third branch of theorizing I'm looking at in the paper is basically the Diamond-Dybvig bank run literature, which is also related to Bernanke's work on the Great Depression. And again, let me repeat, yes, all this thinking works along mainstream lines. Banks take deposits, which they lend out and so on, right? But still, there may be something we can learn from this analysis. The idea that liquidity is runnable, right? And this actually is equally true for money market funds, and it may be equally true for stable coins or whatever near monies we are talking about. These ideas may be relevant. Of course, we know liquidity is not a challenge for the system as a whole, as long as solvency is not the matter, right? There's way to adjust for it by the system. But then it depends, what kind of system are we talking about? What kind of structural changes are we seeing? How does the liquidity adjustment within the system actually work when these changes are happening? The fourth branch I looked at concerns industrial organization, economies of scale and scope, and there's quite extensive literature on economies of scope, much of it being related to the question whether banks might be too big to fail or too big to save, and whether banking regulation itself may be a factor as an implicit subsidy to encourage banks which are too big to fail and all that. In reality, of course, we do see some giant banks, internationally active giant banks, but we also see smaller entities, so they kind of can coexist, apparently, despite the fact that economies of scale seem to matter. Economies of scope, I haven't found much interesting work. This literature seems to focus on banking more generally. It's not so much focused on like lending, deposit taking payments, which is kind of the historical trinity that I'm particularly focused on. So I don't know from this literature what to say. It is, however, related to this idea narrow banking, which is basically trying to unbundle banking, taking the lending part out by law, right? So I'm looking at whether market forces, whether innovations might drive in that direction. We have this approach that tries to do exactly that, taking the lending part out by law. And there's a long tradition of thinkers along those lines. Which brings me to the point of regulation. How should banks be regulated? So coming from kind of Schumpeter, Keynes, Minsky, regulation should aid banks to operate efficiently in the micro sense, picking the right projects, and also enabling kind of policymakers to get the macro management right, so to speak, right? So that I would think would be the general approach from Keynes, Schumpeter, which I should add are kind of representatives of, broadly speaking, the banking school tradition. Of course, we have a long tradition of broadly currency school thinkers, which are more narrow banking, the idea that you can precisely define and identify what money is, and we can, by some legal trick or whatever, kind of bottle up money and thereby forever control money. And also that's one school of thought, and Keynes and Schumpeter were definitely not thinking along those lines. And then the question or the challenge is that financial regulation must continuously adapt to innovations, changes in technology, changes in competition, and so on. So regulation has to adapt, but obviously it's also operating the other way around, that the players are constantly adapting to regulation. And a lot of their playing is actually about trying to circumvent or at least lower the pressures from regulation. We call that regulatory arbitrage. So this is a kind of long-running two-way relationship which is constantly in flux, right? There are constant changes. So it's really Schumpeterian evolutionary perspective on this matter is fundamental. Forever, we've had competition focusing on the lending and the deposit-taking parts. And I mentioned kind of extending chains of financial intermediation that we're seeing. What is pretty new is that banks are under pressure on the payments part. For a very long time, innovations in payments were not really an issue. Yeah, at some point we started using ATMs and so on, and at some point central bankers switched their infrastructure to real-time gross settlement, so on, but otherwise not much happened, except in the last 10 years or so, a lot has been happening. So that gets me to looking into those specific innovations, the new players, although that we're talking about, and I will mainly focus on 3 countries or unions of countries, the big players on the globe. So who are the challengers? Well, one group of challengers we call fintechs, and they are really about technology. They bring new technologies that they are not traditionally involved in banking or whatever, but they use those technologies to get involved in the financial industry, and a lot of that has concentrated on payments. Then we have the so-called big techs. They're also about technology, but there's a fundamental difference. These guys come with a huge network, right? So think Facebook and Libra and those ideas, right? So there's a fundamental difference between these two kinds of players. Thirdly, we have cryptocurrencies. And here we have to make a very important difference or distinction. The traditional cryptocurrencies like Bitcoin, in my view, are nothing else but online gambling. And to the extent that they've been used for payments, it's been used for illicit transactions. So we call those things currencies. I would call them highly speculative assets used in online gambling and for transactions that we would rather not see happening. Now, fundamentally different are stablecoins. And they seem to provide, potentially, a real alternative for future payments. So the point here is they use the same technology, distributed ledger technology, or like commonly called blockchain, but they are not volatile, right? Stable means they are pegged to some currency, typically the US dollar, and they promise to keep a stable value to the US dollar. And there are interesting developments in that field. Lastly, we also have central bank digital currencies. So these are products. Central banks around the world are exploring projects along these lines. We have a few examples. Some central banks have issued those CBDCs, Most importantly, the ECB is thinking about issuing a digital euro at some point. So these products too are embracing the technology, basically, so they are crypto in that sense, right? So we got to be careful here how we use crypto. Crypto, if we mean the technology, I think it's highly useful. If by crypto we mean cryptocurrencies, we're talking about rubbish in my view, right? So that's the fundamental difference here. So in China, we've seen extremely interesting developments, which many people, I think, justifiably refer to as a revolution. 10 years ago, I think cash, banknotes, were still everywhere in payments. Over just 5 years or so, that changed fundamentally, and it was driven by China's homegrown big techs, which developed new payment systems and basically captured the whole market. And interestingly, the Chinese authorities, for a brief period of time, just let go of the reins and just let it happen until things got too wild and they had a lot of fraud and stuff happening. Then they reined it in and basically brought the new payment system developed by those private players, kind of brought it within the old system and forced those players actually to have basically turned it into narrow banking. They now have to basically have their reserves as central bank deposits. So China had this revolution in payments. It was accomplished by these players, but the authorities at the end of the day brought it back under control. And that's where China is. The EU, the situation is rather different. Europe has lots of fintechs. It doesn't have homegrown big techs. It's good at regulating, so the European Commission has fairly early, lots of critics would say far too early, come up with regulating crypto and updating the payments regulation. The reality is that payments in Europe are dominated by US players, MasterCard, Visa, PayPal, and so on. So Europe has little in terms of homegrown players that could reshape how things are done. The US had a pretty outdated payment system, I would say, and payment regulation. But a couple of months ago, we had the Genius Act, which could drastically reshape, I think, the US system, depending on how it goes. And it's essentially a bet on stablecoins. I'll talk a bit more about stablecoins in a second. So the situation in these three big players is pretty different. And if we look around the world, we see lots of experiments, successful experiments, like Brazil's PIX, and India had a very successful fast payment system launch. And we see all these trends around the world. We also see attempts to coordinate that through the G20 to possibly link up fast payment systems of different countries and so on. So there's a lot happening. And one thing that becomes ever clearer every day is that this is now part of geopolitics, right? And let me again focus on the three big players. China has clear ambitions to become less dependent on the dollar and to some degree internationalize the renminbi. So it has this cross-border payment system. It has launched a central bank digital currency for retail use. It has by now bilateral swap lines with a whole bunch of central banks. There are, of course, those BRICS ideas and initiatives to de-dollarize. An important context here is the Russian sanctions, the weaponization of the dollar, right? So all that is the background. China is not fond of cryptocurrencies, and I'm not sure where they stand on stablecoins. I think their ambitions are focused on payments for trade. I don't see them having much ambition to globalize their financial system or become kind of a competitor of Wall Street, so to speak. They are focusing on international trade. They will keep capital controls, and that is going to limit the use of the renminbi to trade transactions. But that's an important part, nonetheless. In the US, ambitions are very different, of course, and they have become much clearer over the last couple of months. Through the Genius Act, but from the start, when President Trump declared he wanted to turn America into the crypto capital of the world, including strategic reserve of cryptocurrencies, which seemed like a really wild idea. It's very different from the idea of promoting US dollar stable coins and basically promoting dollarization in countries around the world. So that, I think, can be a very serious matter. The first one, the strategic reserve, is, okay, the less I say the better, but I think the second factor is a real factor, and this is where kind of global competition is playing out. For Europe, the challenge is how to navigate what is happening. This is true both for trade, as it is true for finance, as it is true for payments. So in Europe, the ECB is pushing for a retail digital euro. There is pushback from the banks. The Commission, the Parliament is, one has to see how this is going to play out. The ECB certainly is pushing in that direction. The notion monetary sovereignty has become an issue in Europe. But I think the ECB also sees this as an instrument basically to push private players in the direction of creating a homegrown Euro area-wide or Europe-wide payment system, which today is dominated by US players. Rest of the world, as I said before, there's a lot happening in different countries, and all countries in the world have to navigate how this competition, this rivalry, in particular between China and the US, is going to play out. Are we going to see a fracturing of international trade? Do we see the formation of blocks? What does that mean for finance? What does it mean for payment systems? What does it mean for dollarization or de-dollarization, right? So clearly, there are different intentions, different ambitions at work here. All right, so are we going to see bank money in the future, and how about state money? There certainly is a blueprint developed by the Bank for International Settlement, which is basically about modernizing the existing two-tier bank money system that we have by basically putting it on a new infrastructure, a new technology, which is blockchain. So blockchain is, it looks like, the future infrastructure of payment systems, no matter where we go. So this blueprint by the BIS envisions this tokenization of bank deposits combined with tokenized central bank deposits, basically wholesale CBDCs plus retail CBDCs, and the tokenization of assets more generally. But this is happening like all within what they call their unified ledger or finternet. So it's going to be a permissioned system where the parties that play within the system, the banks, are kind of controlled by central banks and so on. So that's one vision. The other vision is, of course, that this is playing out through stable coins, right? So purely private monies that can be used globally, which are pegged to some currency. It looks like all dollars. I mean, there's some other currencies, but it's basically all dollars. And then the question just is it regulated? Is it onshore, kind of like what we're seeing now in the US, or is it happening offshore, like it has happened until now? Are those systems going to be fully interoperable, or to what extent will they be separated? To the extent that they will all be connected, of course, we also have to think about interdependencies, right? If there are vulnerabilities in the stablecoin crypto universe, how could they infect the traditional financial system, even if the traditional banking system moves along the lines that the BIS foresees based on a new infrastructure and all that, right? What are the risks potentially stemming from stablecoin and crypto to infect the old system? Okay, implications for monetary policy and liquidity support. I think we're really seeing this play out in the US if we look at what happened in response to the global financial crisis, and what happened again in response to COVID, what happened 2 years ago in spring 23 when we had examples of how crypto stuff can affect banks. So the two systems are clearly connected already. And what we are seeing is that the traditional thinking about lending of last resort, which focuses on banks, that alone is not working anymore, right? So if you look at the list of programs that the Fed put in place in those situations, it's all about making sure that they can inject emergency liquidity in many different places within the system in order to keep the system running. So those kind of ever more extended chains of financial intermediation require the Fed to go well beyond just supporting the banks. Talking about financial innovations and how this might affect financial structures, right? If it's affecting financial structures, again, it's a new challenge for central banks to exactly identify how those structures are changing and where they would have to put support in place when stuff happens again, and we can be sure it's going to happen again at some point, right? It's just a matter of time. Liquidity is of the essence, indeed, and I think the three economists I focus on here are really, they use different words, they emphasize different aspects, but they're really talking about the same phenomenon, right? When Schumpeter talks about evolution, he talks about a future that is uncertain, that nobody can predict. So Keynes and Schumpeter are really looking at the same thing, and Schumpeter may emphasize that banks create liquidity to make the change happen. Keynes emphasizes that the system needs liquidity because this is where you seek safety in an uncertain world. So these are different aspects of the same phenomenon, and it's the phenomenon of capitalism where uncertainty is real and the future is unknowable. So it's not the world that the mainstream is thinking about where money is neutral, right? So this is again getting back to my starting point, that these folks have a very different view of how capitalism works. So how do stablecoins fit in here? Well, one important thing seems to be that they are far less elastic than banking is, right? Bank money is elastic. And if that is gonna shrink, then I see the banks as the second line of defense. Kind of they're closest to the system's primary liquidity, which is the central bank. The banks are kind of the second line. If that second line is shrinking, then the central bank has to do correspondingly more, and I think that's precisely what we have seen already, that the Fed has to look in the system, kind of where do we have to add elasticity when the system goes into panic mode. All right, very briefly, monetary theory. I think it's fair to say that there is quite a tradition of what I call excessive simplicity in macro theorizing about money and finance. And that includes all sorts of different branches, and it's certainly true for today's DSGE models. Of course, central bankers have to use those models. They can hardly ignore state-of-the-art macro. But what we see is that there is actually a ton of research going on in central banks and at the BIS in particular. There's a lot of good work happening there, I think, which is looking very precisely into financial structures and how they're changing. And the challenge is for central banks to kind of stay on top of things, not fall behind the curve, to be able to assess monetary policy. Unless, of course, AI is going to solve all these problems. Perhaps we have the AI central banker going forward. Anyway, let me conclude. So, better payments, faster payments. Yeah, it could be an efficiency booster, I agree. Or make life more convenient. I guess we are experiencing that. That's all good and fine. The question is, do these innovations create change in financial structures, which could have repercussions that we better take into account? Do we see an unbundling of banking? I'm not so sure. We definitely see ever more extended chains of intermediation, but banks do remain very crucial until today. And I don't think that banking on payments is really outmoded. What we're seeing is more, I think, that there are players who are coming in who use payments as their entry point, and starting there kind of become more bank-like institutions. So the old game may still be in place, it's just a new round of shadow banking, so to speak. Can regulation keep up with that? We'll see. Thanks very much.
Have some time to take some questions.
On the stablecoin and dollarization, I was curious if you thought that that might pose an issue for developing countries in terms of reducing fiscal policy space by impacting the sovereignty of their currency. Is that something you at all concerned about?
Yes, I am. Just like financial liberalization in general, opening up financial systems makes those countries more vulnerable to whatever ideas might at the moment play out on Wall Street. And if this extends to payments through stablecoins, dollar stablecoins, it will definitely reduce the policy space of developing countries, which essentially become more dollarized. They become more dependent on the Fed, and whatever the Fed does, whatever Wall Street does, becomes more of a factor playing out in those countries. Of course, people will say, oh, these are all mismanaged economies, so the markets will just bring in discipline, it's all going to be for the good. Not so sure.
You mentioned the development of stablecoin and asked whether regulation can keep up with it. But it seems to me that the promotion of stablecoin seems to be deregulation in disguise, because if we remove KYC, if we remove fraud protections, the current US banking system seems to be able to do whatever a stablecoin can do. What do you think?
Yes, we have a system, a payment system in place, developed over a very long time. We have regulations to check for money laundering and terrorist financing and tax evasion, all that. We have all that. It's working to some degree. Of course, it's not working perfectly because there's places where you can easily avoid those things. Whether stable coins, well, I think I said at the start, like what we call cryptocurrencies has been used for many of those purposes. We know that. For stable coins, the issue is whether bringing them under regulation, bringing them onshore through Genius as an example, whether that's gonna make sure that we can have the same protections for stablecoin payments that we currently have for bank money payments. That's the question. I'm not sure. We'll see. Yeah.
I guess for these past two questions to continue, the way I understand it is I'm hearing people say that it's going to create private money again, that it's going to be tied back to U.S. Treasury, i.e. giving sanction to issue stable coins that's tied back to U.S. the debt system, etc. And to his point earlier about, consumers around the world on their phones are usually tied back to a U.S. tech company, i.e. a stable coin, i.e. U.S. governance. And the idea of regulating and overseeing is going to be the tech companies are going to have to perform that as a surrogate, a private security oversight for us, which I'm sure everyone is worried about data collection, etc.
Yeah.
And actually going back to something you said earlier with a great impression, that banks were the original data miners. So if you think about the world we're entering now, it's the same structure. They literally know everything about you.
Yep.
So the idea of the payment system is ownership as well, and governance, leveraging, etc. So if you think about it that way, that's what's pretty fascinating. That's what really clicked for me. And I think the idea of stable coins on that subject, it's actually going to ingrain even further hegemony of the U.S. dollar system for surveillance purposes, for steering you, turning you off and on, etc. So yeah, as even if you can say BRICS were an honest, foil, I mean, they're really part of the system as well. And I think they have their own means to do it in their own jurisdictions, we'll say. But I guess, I'm trying to find a way to stop, but I guess is the way to consider that what banks were. I think that the structure that we're entering now digitally is really the same function. And you're surveilled, essentially.
Yeah, I agree. I think that's
Maybe
why
worse so.
the administration is promoting this.
Yes.
Right? It's about extending dollar power. Money is power, right? And yes, it's privatized power through those big tech companies. Sanction, yeah. Is that going to be benign? Is there nothing to worry about happening? Well, I think there's a lot to worry about. So it depends on who is issuing the stable coins, right? And how effective this oversight is going to be. How effective is it intended to be? Is the intention just to make them kind of safe by forcing them into treasuries, primarily treasuries? Or is the intention also to properly extend the oversight we have over banks to those issuers, whoever they may be?
And a slight follow-up, because you're German, if you can comment on what seems to be a change of the German economy, the model of industry, of banking being more localized, and the strength is being local community banks, that is based on character and that feeds up. And it seems like there's an erosion, and I just have a friend who has a small business in Munich, and he's noticing changes in how he's feeling downward pressure from Europe, from US, other actors, that there's change in their economic model, even how they understand how economies work on a local level. Now, if you have any comment on changes that might be happening there.
Well, there's definitely a lot of change happening in Germany. The German model is broke. The Russia shock, the China shock, and the US shock hitting Germany at the same time. Manufacturing is shrinking. The export engine is not firing. Germany is in trouble. To just focus on the banking system, right? Germany has its traditionally very fractured banking system with plenty of small credit union savings banks and so on. There has been forever a lot of pressure on basically consolidating the system, the pressure coming partly from Europe, banking union, savings and investment union, Draghi report, kind of this pressure is continuing to pile on. And of course, there's also global forces that push the system in that direction. It depends on whether you believe the official narrative that the old system is totally inefficient and should be replaced by something that is more like whatever we have in Britain or the US. Funny thing is, if you look at what's happening in Britain, everybody knows that their system is not efficient either. So I don't know, right? So, but definitely plenty of change in Germany at the moment, yeah.
Questions? Okay, well, thank you very much